Unlike what the majority of people say, you will not become wealthy by just avoiding Starbucks, and you will not become wealthy by just simply earning a six-figure salary. Let me show you. See, everybody wants to become rich, but only a fraction of those people who want to become rich ever will achieve any sort of financial freedom. The question is, why? Is it because the system is rigged against you? Is it because of your work ethic? Or is it because of something else? Let me start with the system. Yes, it is rigged against you. It is profitable to keep you poor and stupid. Our education system doesn't teach you to become wealthy, it teaches you to be an employee. Then we never learn about how to use our money. In fact, if you learned how to use your money, it would be very unprofitable for the system, because the reality is, if you don't understand money, it's much easier to sell you a loan to go out and finance your next vacation. It's much easier to sell you credit card debt, that way you can go finance all the Gucci and Louis Vuitton that you want. It's very easy to sell you things that you don't need because everybody else on Instagram is buying it. So yes, it is profitable when you spend all of your money, because that stimulates the economy. And despite that, some people will have success dropped onto their lap. Some people will be born with rich parents who will give them everything. Some people will have that success easily handed to them because of one reason or another. But the reality is, despite that, kicking, complaining, screaming, crying is not going to pay your bills. And the reality is, despite the system being rigged against you, you can still win in the system if you understand how it works. And by the end of this video, you will know exactly what that means. But what about your work ethic? Because there's a lot of people on the internet especially who keep saying that you don't need to work hard, you just got to work smart. And if you find the right system, you can sit on a beach and make six figures a year. But the reality is, if you don't work hard, it is going to be impossible for you to ever achieve any sort of success. But hard work by itself isn't enough. But the third thing, and the most important thing that stops so many people from ever having a chance to ever become wealthy, is that we don't know how. School teaches us to be an employee, maybe even a high-paid employee, and that's it. If you want to become rich, or if you want to become wealthy, that's a whole different skill set of financial education, and these are things that most of us are never ever taught. Let me show you. Over here you have cousin Bunty, who graduated school making $100,000 a year, and over here you have sister Paramjeet, who graduated school making $50,000 a year. By the way, in my native language Punjabi, you call a mustache a much and a braid a gut. Now, based off of this information, if both of these people started investing 15% of their income when they started working, because they were both financially savvy enough to start doing that, that means cousin Bunty started investing $15,000 a year as soon as he graduated school, and sister Paramjeet started investing $7,500 a year as soon as she graduated school. Based off this information, you would think that cousin Bunty is going to end up richer and wealthier, because for one, he's making more money, and number two, he had that financial savviness to start investing at the same time as her, and he's also investing more money than her. But you've also been following my videos long enough to know that this is a trick question. See, the difference between cousin Bunty and Paramjeet is that cousin Bunty just gave his money to a money manager, and he was able to get a 7% average rate of return on his money after all fees. Not bad. But Paramjeet decided to do something a little bit different. She decided to go out and learn about investing. She wanted to manage her money a little bit better, and she was able to get a 10% annual return on her money, even though she's investing less money, but she was a little bit more involved on the financial education side of what to do with the money that she actually earned. Well, after 40 years of putting their money to work, cousin Bunty had about $3.2 million. Not bad for a guy making a good six-figure salary. But Paramjeet now, after earning a 10% return on half of the money that she's investing here, has $3.6 million in her investment account. Even though she made half as much money as cousin Bunty, she was investing half as much money as cousin Bunty, but because she did a little bit better with her investments, she ended up with more wealth and more money than cousin Bunty. This is where financial education becomes so important, because when we go to school, we learn how to get this. You learn how to get a salary, and that's it. See, in this situation, we're looking at it from a utopian point of view, where both of them actually started investing their money when they started earning, but most people don't do that because most people don't understand what investing is or the importance of investing, and so most people don't do this. But because they started doing that, they ended up with decent amounts of money. But school only teaches us this part. When in reality, if you really want to become wealthy, there are 3 different aspects to this financial education. Number 1 is how much money you earn. Number 2 is what do you do with the money once you earn it? What type of returns can you get? Because a higher return can significantly change how much wealth you get. And this higher return is going to depend on now what fees you're paying and how much returns you can get, meaning how your financial education is going to impact your investments. And the third thing that will impact how much wealth you build is how long you invest your money for. In both of these instances, we assumed that they started investing as soon as they started earning money. And if you don't start investing your money sooner, you're going to have to start playing catch up, because time is one of the most important factors when it comes to building wealth. So if you want to build wealth, there's 3 things you have to understand: time, the return that you get on your money, and how much money you invest. Now, how much money you invest is the only part that we learn in school, but there are many ways to earn money without your traditional job. You can go out and create an income from a side hustle, from a business. You can go out and get a certificate. There's a lot of different ways to earn money. The more money you earn, the more money you have to invest. But when the majority of people earn more money, they just go out and dig themselves into a deeper financial hole. This is where what I want you to do is, number 1, understand that if you want to become wealthy, you can't spend all of your money. You got to take some of the money and put it to your investments. Number 2, you want to start sooner rather than later, because the more time that your money has to compound and grow, the wealthier you become. And then third, if you really want to become wealthy, you have to understand how can you increase the returns on your money, because the faster you can double your money, the faster you'll be able to build wealth. See, all this rate of return is telling you is how long it's going to take for your money to grow and how fast your money is going to grow. This is the velocity of money. The higher the rate of return, the higher the potential risk, but also the higher and faster that your money can grow. And so now if you want to double your money quicker, you got to understand, how do you get a higher rate of return on your money? Now, this might require you to take on more risk, which is why starting a business has a much higher rate of return. If you start a business, you can get a 20, 40, 50, even 200% return on the money that you invest, but you're going to take on way more risk. And this is where now understanding how much risk you need to take to get the returns that you want is going to be so important, that we can actually hit the wealth that you want. Let's break this down now, because it's easy for anybody to say, just go out and start investing 15% of your money. But if you have credit card debt, or if you don't have any savings, and if you don't know where to start, what do you actually do? So let's break this down step by step, because the very first thing that you want to do before you go out and start investing your money is, number 1, you want to save $2,000 ASAP. This is building your financial base, because if you want to build a home, the first thing you got to do is you got to lay that foundation. And the very first thing you need to do is you have to save $2,000 as fast as possible, because if you don't have $2,000 saved up for an emergency, you are in a financial danger zone. Because if anything bad were to happen, if your window breaks on your car, or if your AC stops working, or if your car breaks down and now you have to pay to fix it, now you have to go into credit card debt to fix the problem, and then you dig yourself into a deeper financial hole. So the very first thing you need to do before you go out and do anything else is you need to go out and save $2,000 as fast as possible. And that means stop spending money, or go out and try to earn some more money, or go sell something that we can put aside this $2,000. And this is money that you do not touch. This is money that you're going to put aside into a bank account that you don't touch unless it is an extreme emergency. If it's a TV that's on sale, or Gucci's having a sale, you don't go out and spend this money. This is money you only use if there's a real financial emergency. Once you do that, the next thing you need to do is you got to pay down your high interest credit card debt as fast as possible. Your credit card debt is skinning you alive financially. We talked about 7 or 10% returns. Well, your credit card company is getting a 15 to 25% return on their money year after year after year. Every time you spend $1 on your credit card that you cannot afford to pay back, you are making your credit card company rich at the expense of you ever becoming rich. You know, it's cool to get the perks from credit cards. I'll be honest. I only use a credit card because I love the cash back that I get. I love the perks that I get. I love the rewards that I get. But the reality is, if you are paying interest on your credit card, if you ever pay a penny in interest on your credit card, you are using your credit card the wrong way, and you are the one that's paying for all the perks and all the rewards for everybody else. So now, if you have any credit card debt, before you go out and start investing your money, you have to pay down your credit card debt. And if you just look at this from a financial level, if your credit card debt is costing you 15% a year, and you're trying to invest your money into the market to get a, say, 7 to 10% return on your money, you are losing your money. Because when you invest your money to pay down your credit card debt, you're getting a guaranteed guaranteed 15% return on your money, because if you can pay down your credit card debt 1 year early, that's 1 year that you don't have to pay 15% on your money on. Versus when you go and try to put your money into the market, you're trying to get a 7 to 10% return on your money, but there's no guarantees. You might get less, you might get more. This is why if you have any sort of high interest credit card debt, you have to pay that down first. Then once you create this financial base, this is where you can go to number 2, where you start actually putting your money to work. And this is where I want you to go out and create 3 different bank accounts. You want to have one bank account for where your deposits and checks come into. This is your spending account. You want to have one bank account for your emergency savings. And then you want to have one bank account for your investment money. The reason why you want to have 3 different bank accounts, and most banks will allow you to do this without much issue, is because you want to make sure you separate the money. The big thing that stops people from becoming wealthy is you spend all of your money. Well, if you don't have any money in your spending account to spend, you can't spend more money. So you need to create these 3 different bank accounts. That way now when you get paid, you get your direct deposit into one account. Then you need to take some of this money automatically. Most banks will do this for free. If they're charging you a fee to do this, look at different banks. You want to automatically take some of this money and have it deposited into your savings account and into your investment account. And when I say investment account, this isn't a technical investment account. I mean, this is money that's going to be invested, because if you go to the bank and you say you want to open an investment account, they're going to interpret it as something completely different, where they are investing your money for you. When I'm talking about this investment account, I just mean a bank account that has the money that is going to be invested. This could be automatically invested into ETFs or index funds through whatever automation you have, or this could be you not taking this money and putting it into investments manually. But it's just cash that needs to be invested. And the reason why you want to do this is because now you have this cash in your spending account. This is the money that you can spend, and now you know this money in your investment account is the money that's going to be invested, and the money in your savings account is the money that's protecting you against an emergency. So what do you do to do this? Well, you got to go to your bank, create 3 different bank accounts, and then create an automation. And one thing that you can do is follow something like a 75-15-10 plan, which is now for every dollar that you earn, 75 cents is the maximum that you can spend, 15 cents is the minimum that you invest, 10 cents is the minimum that you save. If you don't like this, you can create your own formula. This is just a simple rule of thumb, where now every dollar that you earn is going to automatically be distributed in this way. So 75 cents is going to stay in your spending account. 15 cents of every dollar that you earn is going to go into your investment account. 10 cents of every dollar that you earn is going to go into your savings account. That way now you have money for savings, you have money for investments, and you have money to spend. Now automatically, no matter how much money you earn, you're going to be living below your means, and you're automatically going to be investing your money in accordance with how much money you're making. The more money you make, the more you invest, the more you save. Now, when it comes to your savings, you want to save somewhere between 3 months to 12 months worth of expenses. So calculate what your monthly expenses are, multiply the number by 3, and then multiply the number by 12. Once you get these numbers, that's the range of how much money you want to be saving. Once you hit the goal of how much money you want to save, you don't need to save more money because your savings aren't growing. They're not there to make you wealthy, unlike what most people tell us. Your savings are just there to protect you against an emergency. Once you hit that savings goal, now you can stop saving that money and you can take that money and invest it instead, because the reality is your investments are what are going to make you wealthy, not your savings. Now, where do you invest your money? Well, you can invest your money into the stock market. You can invest your money into the real estate market. You can invest your money into your own education. You can invest your money into your own business idea. You can invest your money into somebody else's business idea. There are a lot of different ways that you can invest your money, but the goal here is you want to put your money into a place that is going to be trying to grow. I say trying to grow because when you invest your money, you are never guaranteed to make money. In fact, you will probably lose money at some point, which is why you want to always do your own due diligence before you invest and never blindly trust a random guy on YouTube. Investing has risks, but the goal is to make more money than you lose. The problem is, in order to make money, you have to go through the experience and the painful part of losing money. Every investor loses money. I have made videos of me talking about different losses that I've had. Like I made a video talking about my worst real estate deal ever on this channel. To date, it is the only deal that I've ever lost money on in the real estate market, and it was a very painful and expensive lesson. But That is a part of the process. You lose money sometimes, and the goal is to make way more money than you lose. So now the whole idea is you're going to take this money that you're putting aside for your investments, and you want to put this into an asset that will grow. That way now your money can be working to make you more money. Because when you go to job to get paid, you are physically working to get paid. Whether you're a doctor or whether you're a cashier at McDonald's, you are physically working in order to get paid because you have to do a task. You're either doing a surgery or you're flipping a burger, but you have to do something in order to get paid. If you don't work, you don't get paid. If you can't work, you don't get paid. But your money can work when you're not working, because now when you own an asset, like if you own a rental property or if you own stocks that pay dividends, or if you just own stocks or businesses or whatever it might be, and you can start with as little as $100. You don't need a ton of money to start investing. You just have to start. The reality is now your money can continue to pay you even when you're not working. If you own an asset, whether it's stocks or real estate, and you're not working, this asset will continue to keep working. The business will continue to keep working. The rental property will continue to keep working even when you're not working, and it'll continue to keep working to put more money in your pocket. Now, does this mean you're always going to make money? No, but it's going to keep working even when you're not working, and this is what wealthy people are working for. Wealthy people are working to own more assets. They're not working to just increase their salary. That is the mindset of the average person. 90% of America is working for a bigger salary. 10% of America is working to own more assets, because the real wealth in this system is built not through how much money you earn, but through how much you own. You can earn way more through what you own than you can from what you do. And guess what? You also pay less taxes on the money you earn from what you own. Because when you own an investment, the money you make from your investments is taxed at a lower tax rate than the money you earn from your job. I can tell you this as an attorney who's not your attorney, but this is where you have to understand that our system is designed to benefit the business owner, and it's designed to benefit the investor. Again, you can kick, complain, scream, cry, but that's not going to pay your bills. When I first found out about this, I was very angry because I was studying to become a doctor, because I thought that's how you win in this economic system. When in reality, that's not true. Now, nothing against doctors. We need good doctors. We need good accountants. We need good attorneys. We need good professionals. We need good people who want to do these jobs. But the reality is there's a difference between your job and your financial success. And if you want to have the financial success, you need the financial education. That means, what do you do with the money that you earn? And this could be money that you earn from your job or money that you earn from your business. And the thing that you have to do with the money that you earn is you have to put this money to work through your investments. Now, how do you invest this money? Well, there's a whole different array of investments out there, and this is where that financial education comes into play of how do you actually invest your money. I'm not going to go super deep into how do you actually do that in this video, because that could be a multi-hour long video, but I have a free ebook through Market Insiders, my education company, where we go over how do you start generating cash flow. Some people like to call it passive income. I like to call it cash flow. How do you start generating cash flow from your investments? How do you start investing your money? And how can you start investing even if you don't have a ton of money to start? This ebook is completely free. And if you want to read this free ebook on how you can start investing and generating passive income, I got the link to how you can download this ebook down in the description below. So now you have built the financial base. Now you're starting to put your money to work, because you have your spending money, your investment money, and you have your savings money. The third thing that you have to do is you have to know how to spend your money the right way, because the big mistake in this economic system is following the consumerism culture. Because most people assume that if you have a $100 pair of shoes, or if you have $100 in your pocket, you can afford a $100 pair of shoes. But that's not true. And then you have a whole new sect of people who say, well, if you have $100 in your pocket, you can afford a $200 pair of shoes because of things like credit card debt, buy now, pay later, 0% APR financing. And this is where now you have to understand the difference between an asset and a liability, and how you can spend money on assets versus liabilities. Liabilities are things that take money out of your pocket and don't grow your wealth. Assets are things that take money out of your pocket but then work to pay you back with more money. Assets are things that make you money, or things that you buy with the purpose of making money. Liabilities are things that you're buying that make you look rich. Nice shoes, nice cars, nice vacations, a nice home. All these things are liabilities. They don't make you rich. They make other people rich They might make you look rich, but they're really not adding to your wealth at all. Versus assets, things like stocks, things like real estate, things like businesses. These things don't make you look rich. You can't show off your stock market portfolio or your rental portfolio the way you can your Gucci belt or your BMW, but your investment portfolio can actually make you wealthy. And that means you're going to have to sacrifice some of your spending in other places. Now, the easiest way to do that is for number one, stop financing things that don't pay you. If you want to go out and buy a new furniture set, a new TV, a new fridge, do not finance it. Even if it has 0% APR, pay with cash. That means you might have to downsize. The reason why 0% APR is so profitable for businesses is because they can get you to buy way more stuff if you buy it with 0% APR, and they can get you to buy something that you wouldn't normally buy because you can buy it with 0% APR. If you wanted to go out and buy a $3,000 fridge, but you only have $600 in your bank account, well, they're going to show you that $600 fridge that you can afford, but then they're also going to show you the $3,000 fridge that you can buy with $300 down, and then you just pay it off in installments. Now you're going out and buying something even bigger. Then you have to use next month's paycheck to pay back last month's fridge. And this is where now, if you live a little bit smaller, you stop financing the things that don't pay you, you'll have more money to actually invest your money, and you don't have to get into this payment scheme of constantly working to pay back last month's bills. So if you want to stop getting into the game, you got to stop spending the money today that we have more money to invest. And it's a sacrifice, and this is where a lot of people are going to look at you like you lost your mind, because when you go from driving a BMW to driving a Toyota Corolla, people are going to think, is something wrong? Are you going into bankruptcy? Is something wrong at home? Is something going on with your company? Did you lose your mind? But in reality, this is where now you're making the decision to change your finances for the better, and you want to actually achieve the financial wealth, which means you're going to have to make some sacrifices today. The fourth thing that you have to do once you're building your financial wealth is now you got to start working to earn more money. And the reason why I say this is the fourth thing that you have to do is because if you give the average person more money, they go out and spend more money. And now, just like what we talked about, you're never going to become wealthy by spending more money. You're going to become wealthy by investing more money. This is why earning more money has the most value and the most impact when you know how to use your money. And this is where you have to know how to spend, you have to know how to save, and you have to know how to invest first. That's what we talked about doing. Once you know how to spend, save, and invest, that's where earning more money has the most impact and the most power, because now when you earn more money, well, now you can put more money to work to make you more wealthy. Now, how do you earn more money? Well, you can go out and try to do it from a job. You can try to get a raise. You can try to get a bonus. You can try to get a promotion. You can get a new career, or you can try to create your own income. For me, I'm an entrepreneur. That was something that was natural to me because I hated the idea of working a traditional job. I couldn't work for somebody else. It just didn't make sense to me, and it didn't align with the type of personality that I had. Now, not everybody's meant to be an entrepreneur. Not everybody has to be an entrepreneur. And you have to figure out what is the right way for you to earn money. Maybe you have that entrepreneurial mindset where you're like, you know what? I don't want to work a job. I hate the idea of having a boss. I hate the idea of clocking in. I hate the idea of trying to create somebody else's dreams. If you do, then try to create your own business. It has become so much more accessible now than ever before. And understanding content and social media is more crucial now than ever before, especially as an entrepreneur and a business owner, because nowadays with the internet, every business needs to have a direct line of communication with their customers. And now with social media, it is so much more accessible to market your products, because before, if you wanted to create something like a pen or a notebook, you'd have to get this pen or notebook into stores, which was very difficult. And there was a lot of politics played in order to get your products into a store. But now you don't have to do that. You can just market your pen or your notebook on social media, make some viral posts, make it go viral, which is a lot easier said than done. But if you can get traction on your content, then you can market your products through it. And this is where now understanding social media, understanding the way that the internet has changed the game, and using these tools to your advantage, that way you can earn more money through your products. Well, that's the name of the game. But then the question is, what do you do with that money? If you're just making more money to buy nice things, you're doing it the wrong way. And this is where now you need to be making more money. That way you can invest more money. And if you're an entrepreneur, that could mean investing more money back into your business, or it could also be investing your money into other assets, depending on what your business is and how you want to use that money. Because when you invest the money back into your business, you can get a much bigger return. It has higher risks, but it also depends on now how much do you want to scale your business? How big do you want to grow your business? How fast do you want to grow your business? But that's a whole different concept for a whole different video of how do you scale your business, which brings me to the topic of number 5, which is now how do you protect your wealth? Because the reality is when people realize that you have money or that you're building your wealth, they're going to try to take their hand, put it in your pocket and take some of the wealth for themselves too. And this is where now you have to make sure you build shields and protections around you legally. Now, I'm not just saying this because I'm an attorney. I'm saying this because I've seen this happen. And this is where you need to make sure you have the right insurances. You want to make sure you have good business insurance. You want to make sure you have the proper other insurances that you have in life, like health insurance, car insurance, and all that. But you also want to make sure you have the right legal shields. So if you're starting a business, look into getting something like an LLC or an S corporation. Talk to an attorney about the right legal entity for you, because this can protect you in case something bad happens, or if you get sued, or if whatever happens in your business, you want to make sure you can protect your personal assets, and having a legal shield can protect you from that. So get an attorney early, that way you can have those shields. And then you want to make sure you're also getting some estate planning protection, because now when you start making money, you want to make sure that, well, one day when you die, hopefully a long time from now, that you can decide where this money goes. Because the easiest ways to create fights and arguments after you die is to let the government decide where your money goes. So talk to an attorney about what the right estate planning tools are for you. Is it a will? Is it a trust? And there's a lot of different types of trusts out there. How can you create these things? And then just start thinking about what you want to do with the money after you pass. That way you can avoid the fights, you can avoid the arguments. That way you can protect your wealth today, and that way your future generations can also understand and have the money that you work to create. That way it's not in the hands of the government. This brings me now to the topic of when you go to investing your money, what are some of the best investments or investment ideas that you can consider? That way you can put your money to work and have your money build your wealth. Most of us have heard that you need to invest your money if you want to get rich. But no one tells us where do you actually invest your money. That's why today I want to go over 5 different assets that you can consider buying, starting with stocks, then real estate, then businesses, then cryptocurrencies, then gold. That way you can understand different types of assets that you can use your money to buy. That way you can use your money to actually make money, because the real key to becoming wealthy isn't by making a big salary. It's by making money and then using this money that you're working to earn to buy assets, because there's no limit to how many assets that you can own. There's no limit to how much these assets can pay you, but there's a limit to how much you can do. And this is where now you have to really shift the way you think, from going from that consumer mindset of just trying to make money to buy things to making money to buy assets, and then using your assets to buy things. This is what the wealthy people are doing. Wealthy people make money, that way they can buy more assets. That way their assets can pay for their lifestyle. Broke people, and the majority of America, are working that way they can make money to buy a nicer car. They're working to make money that way they can have a bigger home. They're working to make money that way they can have another vacation. But you're never going to be able to build wealth if you're constantly making money just to spend it. If you want to become wealthy, you have to make money to buy assets, and then use these assets to actually make you money. That way you can make this money without you having to physically go to work. That way you can keep getting paid no matter what you're doing. That way next time you go on a vacation, your assets continue to pay you. Now the question is, which assets do you buy? And I'm going to be going over 5 in this video. Let me start by talking about number 1, which is the stock market and stock market assets. See, when most people think about investing the money in the stock market, they're thinking, how can I find the next Amazon? But that's not the only way that you can make money in the stock market. And in fact, that's how most people end up losing money in the stock market, is because they're trying to find the next hot stock without a long-term game plan, and they're just trying to find the next way to make money quickly. And that's why the majority of people end up losing money in the stock market, even though the stock market has gone up historically over the last century, even though we've had periods of market crashes, we've had periods of recessions pretty much every decade. But yet most people want to continue trying to find the next hot trend, the next hot stock, the next hot meme stock, instead of actually trying to find the next real investment. And I'm going to break this down into 3 different categories. Number 1, we'll talk about the different things that you can invest your money in the stock market. These are things like stocks, index funds, mutual funds, and ETFs. Then I'm going to go into investing in cash flow producing stocks versus non-cash flow producing stocks. And then I'm going to go over what is your stock market investing strategy, whether it's a passive strategy or an active strategy. Let's jump into now understanding the difference between stocks, ETFs, mutual funds, and index funds. When you go out and you invest in a company like Amazon, you're investing in one individual company and you're taking on all the risk. And this is what most people think stock market investing is, just trying to find the next hot stock. But for 90 to 95, maybe even 98% of people, you should not be investing in individual companies, because when you invest in an individual company, you need to be keeping up with the company. You need to be keeping up with the earnings calls. You need to be keeping up with the finances of a company. You need to be keeping up with what the company is doing on the innovation side. You need to be keeping up with the moat of the company. How easy is it for competitors to come in to compete with this company? And if you're not interested or not willing to or don't have the time to do so, you probably shouldn't be investing in individual companies, because then when you see a company that you invest in go down and you don't understand what's going on, it could be much easier for you to panic and sell, or it could be much easier for you to go in and buy because you keep hearing the stock go up. And this is where now understanding if you are interested in actually doing all that work and taking on that risk, because the reality is when things are good, you get all the benefit. If Amazon takes over the world and you own the Amazon stock, hey, you're going to make a lot of money because the Amazon stock is going to go up. But if the CEO of Amazon drives the company into the ground and they go bankrupt, you lose all of your money, because now your money goes on to zero. And that risk can be a really hard pill to swallow for people, especially when things are going down, but it's very easy to understand when things are going up. But the alternative is, instead of investing in an individual company, you can look at investing in a fund. What are these funds? Well, you have index funds, ETFs, and mutual funds. The way the index funds work is these are what are considered passively managed funds, meaning they give you exposure to a certain group of stocks which is managed by a computer, which means that the fees that you pay on these funds are significantly lower than when they're managed by, say, a person. So there are index funds that give you exposure to something like the S&P 500, which is a group of the largest 500 companies on the stock market. And if one of the companies in this fund starts to struggle and they're no longer one of the 500 largest companies, a computer can kick that company out and put a new company in that where it's all automatic. So you have index funds that can give you exposure to many different types of funds, like the S&P 500 is one. There are index funds that can give you exposure to the Dow Jones. There are index funds that can give you exposure to the NASDAQ. There are index funds that give you exposure to healthcare stocks. There's a lot of different types of index funds out there, but these are generally passively managed, so the fees are less. The second thing about index funds is that there are restrictions to how often an index fund trades. So if you wanted to go out and buy the Amazon stock, you can buy and sell that stock in a second. Versus with an index fund, they generally only trade one time a day. This way, you don't have that same volatility, and you can't have people just buying in and out of index funds. You can buy it or you can sell it once in a day, and that's it, because these are long-term investments. And the third thing you have to understand about index funds is that they generally have minimums of how much money you need to invest in order to purchase an index fund. It might be $500, it might be $3,500, it might be $5,000, where you have to invest a certain amount of money in order to own an index fund. A mutual fund works kind of like an index fund, except mutual funds are generally actively managed. So now, instead of having a computer manage and create the algorithms, with a mutual fund, you generally have a person, a money manager, who is working to try to beat the market. Now, this might sound good in theory, but many times this higher fee is not going to justify the returns that you get. Because what we've seen happen over the last decade, Moody's did a study, and they found that about 75% of the time, a high-paid money manager managing the mutual fund did not outperform the market. Meaning, if you just bought a low-cost fund, you would have gotten a better return after factoring the fees. So, is a mutual fund ever worth it? No. Just understand that the higher fees are going to make it less attractive, so you want to pay attention to the fees. Mutual funds also trade generally one time a day, and they also generally have a restriction on how much money you need in order to go out and buy a mutual fund. Then you have ETFs, which are kind of a hybrid between index funds, mutual funds, and stocks, because ETFs can be either passively managed or actively managed, just depending on whatever the ETF is. But the big difference between ETFs and index funds and mutual funds is that ETFs trade just like stocks, meaning you can buy in and out of an ETF as many times in a day as you want because they trade just like stocks. So if you want to buy an ETF in the morning and sell it in the afternoon, you can do that. And generally, ETFs don't have minimums of how much money you need to invest if you want to actually own an ETF. So what is the right thing for you? Well, this just depends on what your goals are and what you like. Me personally, and I can't tell you what to do. You got to always do your own due diligence and never blindly trust a random guy on YouTube. Don't do what I do. I'm just telling you what I do. I personally like ETFs because they're the most convenient and they're easy for me to purchase and they're easy for me to sell. And I like that convenience factor with ETFs. So for me, I like ETFs. But this is where now you have to understand what is your goal when you invest your money. Because for me, I like cash flow. Cash flow means that when you put your money into this thing, yeah, you want this thing to go up in value, but it's also paying you while you wait. And in the stock market, this payment is called a dividend. A dividend is when a stock pays you money for doing nothing except owning the stock. Not all stocks pay dividends, but some stocks do. And if a company is paying out a dividend, this means a few things that you want to understand. Because number one, it means that a company is making a healthy profit. And now, if a company has this profit, they can do three things with this extra cash. They can save this money for an emergency or a rainy day. They can invest this money back into the company to invest and open more stores, to invest in research and development, and to help grow the company. And the third thing that they can do if they don't want to invest this money back into the company, or if they don't want to save this money, is they can give this money away to their shareholders, meaning the owners of the company. Meaning people like you. If you own one share of a company, you are one of the owners of the company. And if they give this money away through the form of a dividend, that literally means they're going to give you a check or they're going to deposit this money directly into your brokerage account, which is a payment that you get for doing nothing except owning the stock. Now, this can sound good for you, but it has its pros and cons that I want you to understand because number one, this means that generally a company's stock price won't grow as fast because now instead of using their money to grow their company and grow the valuation of their company, meaning grow the stock price, they're just giving it away. Second, this also means that you have to pay taxes because when you get paid, you have to pay taxes. And so now when you get paid a dividend, there's taxes that you have to pay on that money, even if you automatically reinvest that dividend. If you get $1,000 worth of dividends and you reinvest all of it back into the company, well, you still have to pay taxes on that $1,000. So something you have to understand, although the tax rate that you pay on qualified dividends is the lower capital gains tax rates, meaning generally you get a lower tax rate on your dividend income than your income that you get from your job. So it makes up for that. But this is where now you have to understand, what do you want to get from your investments? Do you want cash flow or do you want to see more growth in the stock? Because if you're investing in a growth company, like a startup company, they're not going to be paying out dividends. Because if a startup is paying out dividends, that means that they're using their money not to grow the company, but just to make their shareholders richer. And if you're a startup, you want to go out and get bigger. You want to get more of the market share. You want to get a bigger share of the bigger pie out there. And that means you got to use your money to grow quicker and faster instead of just trying to make your owners richer. So if you want to see the big growth in a stock price, well, then you're probably not going to be investing in the dividends. If you want more slow and steady growth, then dividends can be a better option for you because you also get that cash flow. And this is where you got to find the right strategy for you. For me, I like cash flow. That's why 75% of my investment portfolio, not my stock market portfolio, but my total investment portfolio are cash flow producing assets. And in my stock market portfolio, I have a lot of ETFs that pay me with cash flow. And I own some companies that also pay me with cash flow. Because for me, I like cash flow. Most of my investments are cash flow producing. Are all of them cash flow producing? No. But most of them are because I like that cash flow, because the advantage of this cash flow is you can go out and buy this thing and it will continue to pay you even when you're going out and sleeping or you're going out on vacation and you're going out and traveling, you're continuing to get the cash flow. For me, I want to have a system where my cash flow is funding my life. That way now I don't have to worry about my money because I own assets that are paying me with cash flow. That's why I like cash flow. And then the third thing you have to decide is, what type of investor do you want to be? Do you want to be more of a passive investor, or do you want to be more of an active investor? An active investor is what I call somebody who is now actively investing in individual companies, where now you're researching the company, you're investing in this company for the long term, and you're going to keep up with this company. A passive investor is where now you set up a system where every week, every 2 weeks, or every month, you're just buying more of the funds, whether it's ETFs, mutual funds, or index funds. You're just buying more of these funds no matter what's happening. And this is consistent, it's passive, and it's automatic. Now, you don't have to pick one. I have both a passive investing system and an active investment system where now I'm looking for individual companies to invest in. And I also have a system where every Wednesday I have money that's leaving my checkings account that's automatically invested into my portfolio of ETFs. And this happens no matter what, whether the market's up, whether the market's down, whether we're in a market crash, whether we're in a market boom. This strategy does not change. I guess the only time it might change is if you go through a market crash. Maybe I'll buy more, but that's it. This is where you have to find the right strategy for you, for how involved you want to be as an investor. Now, let's diagram this out so you know exactly what this looks like. Let me start by going over a few dividend-paying stocks. And again, as a reminder, I'm not telling you what to invest in. These are just examples. So at the time of recording this video, Verizon is paying out a 7% dividend on their stock. McDonald's is paying around a 2% dividend on their stock. Bristol Myers, the healthcare company, is paying around 3.2% dividends on their stock, and then Apple is paying around 0.5% of dividends on their stock. Now, what does this mean? This means that if you go out and invest $100 into a company that's paying, say, a 7% dividend, that means for each $100 that you invest over the course of 1 year, you're going to get $7, which is 7% of $100 in cash flow just for owning that stock. That doesn't include the stock price going up or down. That's just the cash flow that you're getting. Now, this percentage can change because the real amount that you want to pay attention to is the dollar amount of the dividend that you're getting. Now, this dividend that you get is typically paid out every quarter, meaning every 3 months. So every 3 months you get a payment, and that payment would be 1/4 of whatever the total dividend amount is that you're getting over the year. And if you don't want to invest in individual companies, you can also look at investing in things like ETFs. Now, here are again some examples, not telling you what to invest in. Number one is SPY. This is an ETF that gives you exposure to the S&P 500, again, which is a group of the 500 largest companies on the stock market. At the time of recording this video, if you invest in SPY, the S&P 500, you would get about a 1.5% dividend. And when you invest in this one ETF, you're getting exposure to the 500 biggest companies in the stock market. Then you have DIA, which is paying around a 2.8% annual dividend right now. DIA gives you exposure to the Dow Jones Industrial Average, which is a group of about 30 companies that are spread across different sectors across the stock market. This is one of the most commonly tracked indexes when people talk about the stock market. If you've ever heard of people talking about the Dow Jones, well, this tracks the Dow Jones. Then you have QQQ. This is another ETF that tracks the NASDAQ. The NASDAQ is a group of 100 non-financial companies. Most companies currently in the NASDAQ are tech companies, but it's a group of 100 very large non-financial companies at the current time. It's paying around a 0.6% annual dividend. And then we have VYM. This is an index which tracks high dividend paying companies. I started because this is an ETF that I'm personally invested in, just so you know as a disclaimer. So this invests in companies that are paying out dividends. So if you're looking for cash flow, this is an ETF that focuses on investing in cash flow producing companies. Currently, they're paying out just over a 3% annual dividend. Before I go on to the second asset class that you can consider investing in, if you do want to learn more about how to actually start investing with a step-by-step guide on how do you start generating cash flow and how do you start investing even if you don't have a ton of money, again, we have a free ebook through Market Insiders that goes through how you can start investing and start generating this type of cash flow. The ebook is completely free, so if you want to read this ebook, I got the link to how you can join down in the description below. The second asset class where you can consider investing your money is into physical real estate. This is one of my favorite places to invest my money, where now when you invest in real estate, what you're doing is you're taking your money, you're going out and you're buying a physical property. This could be a single family home. This could be a condo. This could be an apartment complex. This could be an office building. This could be a retail building. This could be a mixed use building. This is going to take more capital and more work on your end, but it allows you to own something that you can see, feel, and touch, and you're buying something ideally for the purpose of creating cash flow. Now, there's a lot of different goals people have when it comes to investing in real estate. For me, my number one goal when I invest in real estate is cash flow. Meaning, when I buy a property, I don't care or try to speculate where property values are going to be next year or 5 years from now. I'm buying the property based off of one goal. How much cash flow will this property generate this year, next year, the year after that, and the year after that? Meaning, if I have to invest $1 today, how much cash flow will this dollar pay me every single year from here on out? This is my analysis when I invest in real estate. I don't like looking at speculation, meaning how much will property values rise next year or the year after that, because it's speculation. There's no real way for me to guess or predict how high property values are going to go. That's too risky for me. Instead, I can look at what this property can generate in rent today. I can predict what the expenses are going to be, and then I can pretty accurately calculate how much my profit is going to be every single month. And based off of that, if there's enough profit, I will consider buying this real estate investment deal. Now, for me, I look for a 7% cash on cash return, meaning for every dollar that I invest, I'm looking for a 7% cash flow. If I invest $1, I want 7 cents of profit after expenses hitting my bank account every single year. If I invest $100,000, I want $7,000 worth of profit hitting my bank account each year from the cash flow alone. If property values go up, hey, that's icing on the cake. If property values fall, oh well, I'm still getting the cash flow. The reason why I want this type of cash flow is because now if we go into a recession or bad things happen in the economy and I have to lower rents, I still have enough margin in there that I can lower rents, still be competitive, and continue to not have to bleed cash, because a big thing that happens in the real estate game when you go through these cycles is people over leverage. They get excited about an area, they get excited about a property, they go in and they overpay, and now their expenses are so high because when you overpay, you have to take on more debt. When you take on more debt, you have a bigger monthly mortgage payment. When you overpay, you also have a bigger property tax bill because your property taxes are valued based on the value of the property. So if you're paying more money, your property taxes are going to be higher, and you also have a higher insurance payment because when you buy a more expensive property or you pay more for a property, you're insuring a more expensive property, meaning your monthly insurance payments are also higher. So now when you go out and overpay for a property, you have higher expenses, and then if bad things happen, you don't have any margin. You don't have any leftover room to protect yourself. So now if you have to lower the rents or if you see vacancies, you can very quickly become underwater, and now you don't have a way to continue making your payments. This is why you definitely don't want to chase real estate deals, because they can really end up biting you in the butt, because when you go out and invest in real estate, it's much more intense versus going out and buying a stock. Because when you go out and invest in real estate, now you're actually managing and operating the property, because now this is under your control. When you go out and invest in Amazon, or you go out and invest in the S&P 500, you have a CEO who is managing this company. All you do was buy a piece of the ownership and a piece of the profits. When you go out and you buy a rental property, you are the management team. Now, I don't recommend you going out and actually managing the property yourself. I don't manage any of my rental properties. I hired a property management company whose sole job is to manage the rentals. Their job is to find the right tenants. Their job is to screen the tenants. Their job is to collect the rents. Their job is to make sure that there's no issues in the property, and when there are issues, to handle and manage the repairs, to make sure that the bills are paid, and to make sure that the properties are in good condition. And this is where now, if you have a good property manager, it can make your life a whole lot easier. If you have a bad property manager, it can make your life a whole lot more stressful. And this is where now that hurdle of getting involved in real estate is difficult, because a lot of people make it seem that investing in real estate is this like amazing thing that is so simple. All you got to do is go out and buy a rental property, hand over the keys to a property manager, and now you're going to be rolling in the money. At least that's how it made it seem to me when I first started investing in real estate, because when I first started investing in real estate, I didn't have any guidance. I didn't know any real estate investors. And so I had to figure it out on my own. And all these books made it seem so easy and like it would not be that painful. But getting started is so difficult and so time consuming, because you have to find all the right people. You have to find the right real estate agent. You have to find the right property manager. You have to find the right contractor. You have to find the right real estate agent. You have to find, the real estate attorney. You have to find the right real estate accountant. You have to find a good property inspector. You have to learn how to deal with city inspectors. There's a big learning curve. But once you get over the learning curve, you find the right people. You go through the pain, you go through the mistakes, which is a process because I've been there. Those mistakes can be expensive, they can be difficult, and they can be very stressful. But once you get through that and you figure it out, then it can be much easier and much simpler. Like when I go out and I invest in real estate today, the process is much more streamlined because I have a team of people that I know who I can work with and rely on, versus when I was first getting started, it was very difficult. The first deal is the hardest. Maybe even the first three. For me, it was the first three deals that were really the most difficult. But once I got past the first three deals, it became much more streamlined, much easier. And this is where now, if you can go through that hurdle, if you're willing to go through the process, you will be able to succeed, but you have to be willing to put in that work. And the next big question or concern that people have is the cost, because real estate investing is much more capital intensive, meaning it's going to take more money. And this is really now a matter of priorities. And what I've seen is when you prioritize investing in real estate, you will find a way to do it. It might not happen for a number of months, maybe even a couple of years, but if you prioritize becoming a real estate investor, you will find a way to put aside the money. That way you can go out and buy property. And when you go out and become a real estate investor, the nice thing is, well, you can build a cash flow because now you own a hard asset that you can rent out that's paying you with cash flow. And in addition to that, you also get some of the biggest and best tax breaks that our tax code has to offer. As a licensed attorney who is not your attorney, I can tell you that the tax code provides a lot of benefits to real estate investors. And in order for you to capitalize on these benefits that a tax code has to offer, you have to go out and actually invest in real estate as an investor. That way you can capitalize on things like the depreciation deductions, the ordinary and necessary business expenses, and everything else that the real estate tax code has to offer. Because now with real estate, not only can you generate income and pay less money in taxes legally, but you can also flip properties. And when I say flip properties, I don't mean like literally flipping properties. I mean buying a property, holding on to it for at least a year, and then selling the property. If you do that and you make a big profit, well, you can defer the taxes on that. So what I mean is if you go out and buy a $200,000 property today, and let's just assume that you hold on to this property for 5 years, and now you happen to buy this property in a great area where rents are rising, property values are rising. You bought the property for $200,000, and hypothetically, 5 years later, you sold this property for $1 million. Now you'd have a big profit, $800,000 worth of profit, which is a big taxable income. But with real estate, you can do something called the 1031 exchange, which allows you to take all $1 million, go out and buy a new, bigger property that's going to pay you with more cash flow, pay you with bigger profits, and pay $0 in taxes today legally, because the real estate has that 1031 exchange benefit, which you can't do somewhere else. If you bought a stock for $200,000, 5 years later it goes up to $1 million, and you sell it, and then you take all $1 million and buy another stock, you still have to pay taxes on that profit that you got. With real estate, you have special rules that don't apply to other places. But before you go out and do that, talk to a professional. 1031 exchanges are very logistically complex. There's a lot of rules and regulations around them, and you got to make sure you have the right people around you. So make sure you have a good accountant, a good attorney, and a good 1031 professional who's going to help you with that. But just understand that when you invest in real estate, you can build cash flow to fund your lifestyle. Like when I was getting started on my financial education journey, when I started investing in real estate, I realized that, holy moly, I can make cash flow. I can get paid without me having to do something, because at the time I was running an event planning company. And the only way I got paid was if I was hosting a party, or I was working at a wedding, or I was doing some event. And then I realized, whoa, I rented this condo out for $600 a month, and now I'm getting this cash flow, which wasn't really passive at the time because I had no idea what to do to make it passive, but I could kind of see the light at the end of the tunnel that one day this could be passive. And from there, I realized the game is just stacking cash flow. If I can buy enough rental properties, then I can make enough cash flow to fund my lifestyle. If each unit can make me $300 a month, how many units do I need to be able to fund my lifestyle? Is it 10? Is it 20? Is it 100? And then just going out and figuring out how to make it happen. And that was the name of the game for me for a long time, was just buying the properties, buying the units, stacking the cash flow. That way now you have this consistent cash flow coming in that I don't have to work to earn. The third thing that you can consider investing in if you want to build wealth is in businesses. Now, when it comes to businesses, there's two different ways that you can do this. One can be in your own business, and the second can be in somebody else's business. My number one place where I invest my money is into my own businesses. Now, I don't really consider this a traditional investment because when I invest my money into my own businesses, like into Briefs Media, which is my newsletter company, that is an active investment because I run that company. I am the CEO of that company. I work every single day to operate and manage Briefs Media. So when I invest money into Briefs Media, I'm working to actively grow that money. And that is another form of investment. It's a way for me to now put my money to work, not into real estate, not into stocks. In fact, over the last couple of years, I've been actively investing less money into real estate, less money actively into stocks. That way I have more money to invest into my own company because I want to grow my own company. Because when you invest your money into stocks or real estate, you're trying to get, again, a 7 to 10% return on your money, which is a great return over the long term, especially as a passive investor. But when you're investing your money into your own business, there's no limit to the types of returns that you can get. So financially, you can get higher returns. It comes with no risk, but then you're also able to grow whatever it is that you're working on. And for me, Briefs Media has a lot more upside right now, which is why I've been investing a lot more aggressively in that. Again, it works for me because I am an entrepreneur. I am that type of person. And so I'm willing to accept that risk that if the company goes bankrupt, I will lose all the money that I invested into it and all my time that I put into it. But I'm willing to take on the risk. If you're not an entrepreneur, you don't have a business idea that you want to invest in, that's okay. You can also invest in other people's business ideas. You can invest in startups. And this was something that I started doing around the pandemic time because I started seeing that investing in startups has become much more accessible thanks to something called crowdfunding. There's new regulations that allow regular people like you, me, anyone with as little as $100 to invest in crowdfunded or startups with small amounts of money. And with this, you also have to understand that when you invest in somebody else's startup, you will probably lose money. The statistic is like 8 to 9 out of 10 startups will fail or go bankrupt within the first 5 years, meaning most of the startups that you invest your money into will lose money, period. You have to understand that when you go in. But the goal isn't to lose money always. The goal is that when you make money that one time, it should hopefully make up for all the losses. But it's a whole different skill set and a whole different type of work and risk, I guess you can call it. But something for me that I really enjoy because I love working with entrepreneurs. I am an entrepreneur myself and I have built a platform fortunately, where I can also help grow entrepreneurs. I can help provide awareness to companies that I've partnered with. So for me, I love this type of startup investing, although I don't do as much of it as maybe I would like because, again, I'm focused on building my own brand, but I have invested in a handful of different startup companies. Now, a few platforms that you can consider using, and again, I'm not sponsored by any of these companies. I'm just letting you know who they are. Number one is WeFunder. Quick disclaimer, I am an investor in the WeFunder Corporation. Number 2 is Republic. Number 3 is Start Engine. These are 3 different platforms where you can go and invest in startups. Now, again, the way that you get paid here is if the startup that you invested in either goes public or it gets acquired. Goes public meaning it trades on the stock market, or gets acquired meaning it gets bought out by another bigger company. If the company that you invested in doesn't get acquired, it doesn't go public, you might never see that money again. If the company that you invested in goes bankrupt, you will never see your money again. So it's very risky, but it has a lot of upside because it's like investing in a new company in the very early stages of its life. And so you can have a lot of upside, but a lot of risk. And if that's something you're interested in, it could be a piece of your investment portfolio. Probably not don't want to make it a huge chunk of your investment portfolio, especially if you're just starting off, but it can be a small little piece of your investment portfolio as kind of a fun way for you to invest in smaller startup entrepreneurs as long as you're willing to understand the risk. The fourth place where you can consider investing your money is into cryptocurrency. Now, cryptocurrency, again, very speculative, very volatile. And the thing that I want to kind of point out here is in my total investment portfolio, 80% of my investments are in things like stocks and real estate. If I take out my own business, I have 80% of my money going into stocks and real estate. 20% is in more of what I call the speculative investments. These are things like startups, these are things like cryptocurrencies, and these are things like precious metals like physical gold. 20% of my investment portfolio are these speculative investments. 80% stocks and real estate. You're going to figure out the right percentage for you, but understand now cryptocurrency falls under that speculative side because it can go to zero and it can also go up very quickly. Now, the reason why I like cryptocurrency is because I have seen the benefit with things like cryptocurrency. I've had contractors that work with me and for me overseas. And paying contractors overseas, sending money that far is difficult and expensive. I used to have to go to the bank. I used to work with a different bank, an older bank, where I had to go to the bank to send wires. Sending a wire takes time and it's expensive. It was like $45 or something, $40 to $45 to send a wire overseas. And I was traveling. I was in California at the time where my bank didn't bank. They didn't have little regional operations over there. So now I had a contractor that needed to be paid and I couldn't send him money. I couldn't send him money through PayPal because his country didn't accept PayPal. I couldn't send him money through Payoneer or I think they changed their name, but whatever that platform was where you can send money to countries overseas. And so it was a big mess trying to send money to him when I didn't have access to my bank. And then I asked him if I could send him some cryptocurrency. He said, sure. And so I sent him cryptocurrency payments. He got it in a fraction of a second or maybe like 5 seconds. And it cost me a couple cents. And that was a big light bulb moment for me where it's like, wow, this has really changed the game of how I can transfer money and how money is done. And so because of that, I own cryptocurrency. Now, I don't own a bunch of the smaller coins. I invest in the big things like Bitcoin and Ethereum and a couple other smaller ones, but mainly Bitcoin. And for me, this is a speculative investment. For me, it's an investment in the future. I believe in the blockchain, but I also understand the risks. I know it can go to zero. If it goes to zero, is it going to affect me? Not really. But if it goes up a lot, hey, that'd be cool. It'd be nice. It'd be fun. So as part of this speculative investment, something that I believe in the blockchain, but I also understand the risks, and that's how I invest my money, where 80% of my investments are stocks and real estate, 20% are some of the speculative things like startups, cryptocurrency, and gold. Which brings me to the fifth place where you can consider investing your money, which is a precious metal like physical gold. For me, I own some physical gold. And when I say physical gold, I don't mean an ETF or paper stocks of gold. I mean actual physical gold. It makes up 2% of my investment portfolio. And for me, I just buy some physical gold every month, and that's it. The reason why I buy gold is not because I'm expecting gold to shoot up in value. I really don't even monitor the price of gold. For me, it's an alternative way to save money because the way that I look at it, again, this is just me. Don't listen to what I do. Make your own decisions and follow your own advice. But for me, what I do and the way that I look at it is if I were to go to my backyard and bury $50,000 worth of cash and also $50,000 worth of gold today, and then I covered it up, and then 10 years from now, I go and dig up these two things, these two piles, I think that the gold will have more buying power than the $50,000 worth of cash in the future. Because of that, I look at gold as an alternative way to save money, and I look at gold as a hedge against the worst case scenario types of situations. And by worst case scenario, I mean of something happening to the dollar, something happening to our economy. That is where gold could potentially have more value. So I don't look at gold like an investment. I look at gold like an alternative way to save money. It's an alternative insurance against doomsday scenarios. So that's why I own physical gold, and that's why the 5 places where I invest my money. And again, don't copy me. Don't blindly follow a random guy on YouTube. Do your own research. For me, the 5 places where I invest are: number 1, my own business and startups. Number 2, physical real estate. Number 3, stocks. Number 4, cryptocurrency. And number 5, physical gold. And this is where you can find the right combination for you. Now, the reason why this type of real investment diversification is so important is because of where we are in the economy and because of all the changes that we're seeing in the economy. Our economy is on the verge of entering a recession. At least that's according to the Federal Reserve Bank, who in their latest meeting minutes said that the United States will likely enter a, quote, mild recession by the end of 2023. Now, while it's impossible to perfectly time and predict when a recession will hit, what we do know is, number one, that recessions are a part of our economic system. Two, we've seen recessions happen almost every decade for a century now, and the longest period since the Great Depression that we've seen without a recession was after 2008 before the pandemic. And third, we have a lot of red flags in our economy today. A recession happens when our economy slows down, obviously. Our economy slows down when businesses make less money, obviously. And businesses make less money when people spend less money. That's a little bit less obvious, but this is where you have to understand that our economic system runs on spending. The more money you spend, the more money that somebody else makes. If you go to Sweetgreens and you look at the price of the bowl and you say, you know what, I'm not going to buy any Sweetgreens, and then you walk out, Sweetgreens isn't going to make any money. But then if you walk into Sweetgreens and you say, oh man, these bowls are really good. This salad is worth $20, which Sweetgreens is the only salad that's worth $20. You walk in and you give them your $20, Sweetgreens just made more money. Now, this is where you have to understand the more money you spend, the more money that somebody else makes. Our economic system runs on spending, which means if you made $1,000 from your job and you spent $100 and you saved the other $900, that $900 isn't stimulating the economy. But if you go and earn $1,000 and then you spend all $1,000 at wherever, well, now you're really stimulating the economy because now you're working to spend all of your money. But this is where I want to take it one step a little bit further. Can you tell me what is the difference between this $20 bill and this $1 bill right here besides their buying power? The difference is this $20 bill is money that I worked to earn. I got this money from my checkings account. And this $1 bill is money that my bank lent me. We live in a credit-based system where if I go and I bought something from you, you're not going to know the difference between this $20 bill or this $1 bill. You don't know if I'm buying something with credit or if I'm buying something with money that I worked to earn, because in our economic system, credit works the same as money. So now, if I go to work and I earn $20 and the bank gives me $1, now I have the ability to spend not $20, but $21. And now I have the ability to spend even more money. So now if I work to earn $1,000 and my bank has $1,000, and then the bank loans me an additional $1,000 with the help of a credit card line of credit or some other home equity line of credit, now I have $1,000 from my job and $1,000 in loans from the bank. Now I have the ability to go out and spend $2,000. Now, for the economic system, that's great news because that means I have the ability to spend twice as much money today. I have the ability to go to Sweetgreens and buy twice as many salad bowls, buy twice as many avocados, and buy twice as many Gucci belts because I have the ability to go out and spend more money today. But this can also cause more severe slowdowns in spending because remember, slow spending causes a slowdown in business profits. A slowdown in business profits causes a slowdown in the economy, and a slowdown in the economy can cause a recession. You'll see how this all ties together. Because now if I go out and I keep spending money on debt, what does that mean? Well, if I'm spending money on debt, that means I'm spending next month's earnings and next year's earnings today. That's what debt is. Debt is you spending your future income today plus interest. So now if I go out and I keep spending more and more money with the help of lines of credit, with the help of credit cards, eventually I'm going to hit a point where I'm going to be over levered as a person because I kept spending and spending and spending, and now the bank says, no more spending for you. No more credit card debt for you. You got to start paying this off. Now when I hit that breaking point where I have too much debt, I can't keep spending. And now I have to use my money not to go out to Sweetgreens, not to go out to Gucci, but I have to use my money to pay down my credit card debt, and I got to pay down my high equity lines of credit. Now, because I have so much debt, I have to use my income more to pay down my debt because I've hit that breaking point. When that happens, now businesses suffer because I've spent so much money in the past number of years. I've built up this huge debt pile, and now I got to start paying it down. And now I'm using my money that I'm working to earn not to spend and stimulate the economy, but to pay down the debt. Now, when you go through this phase in the economy, which is after the point where people are over-levered, now people are working to pay down their debt as opposed to spending and stimulating the economy. So now when people are working to pay down their debt, that means businesses aren't making money, or at least not as much as before, because more and more people have to now pay down their debt. So that's why when you see these debt bubbles happen and people get over-levered, eventually you hit a breaking point where the credit stops flowing. Banks stop issuing more money because people have too much debt and now they need to be paid back. And now when people are paying the banks back, now people aren't spending. When people aren't spending, that means businesses aren't making as much money. When businesses stop making as much profits, that means they don't have money to invest in new stores. They don't have money to hire more employees. They don't have money to invest in research and development, which then causes the economy to slow down. When you see the economy to slow down, well, that's what a recession is. When you see a economic slowdown, especially over a period of at least 6 months, that's what causes a recession. So an economic slowdown is what causes a recession, but an economic slowdown is caused by a slowdown in business profits, and a slowdown in business profits is caused by a slowdown in spending, and a slowdown in spending is caused when people get over-levered because people have already spent too much. So after you hit that breaking point, that's when you start to see that recession, which is very interesting because that means that you generally see a recession happen after a big economic boom. And that's exactly what happens. If you think back to our most previous recessions, besides the 2020 pandemic, because that might be a little bit of an exception, even though we were kind of in a booming economy before the pandemic, but that was kind of like a forced recession because the economy was shut down. But before the 2008 recession, well, we were in a boom economic period before the economy crashed because everybody was buying a home. People were living large. Everybody saw their wealths rise because if you bought a home, you saw this astronomical rise in wealth because people saw the property values grow, so people were buying things, and businesses and banks are making money hand over fist until you saw this over-levered period come, and then it all came crashing down. Same thing before the 2000 dot-com bubble bursting. What happened then was we saw this huge rise of internet companies right before the year 2000. And people who were investing in these companies were making so much money hand over fist, and people were living large. They saw how much money they were making so quickly. People were able to spend big, live large. And then came the year 2000 when the party came to an end because the credit stopped flowing. And that was when the bubble burst. And you saw a lot of people lose money very quickly. So you see this economic boom period followed by too much spending, followed by too much debt, which then leads to, well, a recession period, which is now where you have to kind of pay down that debt and reset from all the spending that you did. And now if we look at where we are right now, we are seeing credit card debt rising. We're seeing household debt rising. We're seeing corporate debt at the highest levels pretty much ever. And this is a period now where also interest rates are rising, meaning the cost of servicing this debt is also rising. And every time we've seen a recession over the last century, over the last 100 years, we've seen the exact same three things happen. Number one, people lose a lot of money when you see a recession or a market crash. Number two, you see some people make an insane amount of wealth when you see a recession or a market crash. And number three, you see the government come in and try to remedy the recession and market crash and try to create programs to prevent market crashes. And most of the time, these programs end up creating a bigger divide between the rich and the poor. And this is where now I want you to understand this, not be shocked by this, not be blindsided by this, but rather be able to find the opportunities, because the reality is, number one, recessions happen. Period. They have happened and they will continue to happen. They happen almost every decade or so. And so now when you understand that, you can understand that you don't need to be so shocked when you see economic pain happen. It is a part of our economic system. But instead of being shocked like the majority of people, I want you to be prepared and find the opportunity. Because while most people end up losing money, getting hurt, getting panicked, and getting freaked out when you see a recession, some people see the opportunity. Now, where is this opportunity? Generally, where the big bubble was. When the 2020 pandemic hit and you saw the recession hit very briefly, we saw the price of pretty much everything, stocks, cryptocurrency, not really real estate, but stocks and cryptocurrency, a lot of paper assets fell very quickly. The investors that came in and bought were able to make a lot of money very quickly because, well, the Federal Reserve Bank opened up the money printer after the 2020 pandemic and then prices skyrocketed. When the 2008 crash happened, well, first it was the real estate market that really got hit. And that was the big bubble. People that bought real estate after the 2008 crash were able to buy real estate for pennies on the dollar. Literally. Like when I started investing in real estate after the 2008 crash, I was buying properties for pennies on the dollar. The first property that I bought, I happened to be in the Metro Detroit area, which was arguably the hardest hit area after the 2008 crash. And the first property that I bought was a condo that originally sold for $150,000. It was a 1,000 square foot condo, 1 bedroom, 1 bath, and it got foreclosed on, and nobody was buying it, and the banks needed to liquidate it, and I came in and I bought that condo for $8,000. That wasn't my down payment. That was the total price of the condo. So literally pennies on the dollar because of how big the bubble was and how much the bubble burst. You also saw the stock market get cut in half during the 2008 crash. If you bought good companies after the 2008 crash, you were able to make a lot of money. After the 2000 dot-com bubble burst, you were able to buy internet companies and a lot of stocks, again, for pennies on the dollar. We saw the Amazon company, Amazon that we know today, Amazon, that stock fell by over 90% during the dot-com bubble burst. Meaning you could come in and buy Amazon for pennies on the dollar, and the people that did were able to make a lot of money. Now, of course, it's risky because people are losing the money. There's a lot of panic. There's a lot of fear. There's a lot of greed. There's a lot of confusion. There's a lot of excitement. And this is where now you need to be able to prepare. That means using your money smartly today. That way you have a financial cushion in case something bad were to happen. You have money to fall back on. And second, you have money to take advantage of opportunities. Meaning you have what people like to call dry powder. This is what people on Wall Street like to call money for investing when things go wrong. That when things go wrong, you have cash, money to be able to capitalize on opportunities, because if you see a good opportunity to invest but you have no money, you can't go out and actually invest. And this is where now preparing when times are okay, that way you can take advantage of times when they're not so okay. It's so important that way you can actually capitalize on the opportunities. Now, where will these opportunities be? Well, a lot of people have been labeling what we're seeing right now an everything bubble because of the amount of money that was printed during the pandemic era, plus post the 2008 recession era. Because of all the money that was printed, we saw the valuations of pretty much everything rise. So we could see opportunities in real estate, in stocks, potentially cryptocurrency, whatever assets that you're looking to buy. There could be opportunities there. And this is where now you need to be, one, financially educated, but then second, you also need to be prepared. That way you can capitalize on opportunities that might come your way. We've already begun to see some of the issues in the banking sector after the Silicon Valley Bank collapse, because then people started to really panic, move their money away from banks. It created some opportunities for investors who did go out and start investing in some bank stocks that they felt were good companies that were hit hard. Again, I'm not telling you what to invest in. I'm just showing you examples of opportunities where we're already seeing pain and concerns in the banking sector. That's one area where people will be able to find opportunities. Some people will lose money there. Some people will find opportunities there. Second, we're seeing a lot of concerns in the commercial real estate market, because a lot of commercial real estate debt is not a 30-year fixed rate mortgage. They are adjustable rate mortgages that will adjust every 5 years or so. And about half of the total commercial real estate debt out there is set to readjust in the next 24 months. And we have a lot of empty office spaces where landlords are struggling to make their payments. And interest rates are so much higher today than they were 2 or 3 years ago. And so when these landlords go to readjust on their commercial offices or commercial buildings that are sitting vacant, and if the bank readjusts their debt twice as high as it was before and their monthly payments double, well, that's going to put a lot of pain and a lot of pressure on landlords who, one, will not be able to qualify for a refinance, and two, who won't be able to continue making the payments because they won't be able to afford all these losses. So that's going to create pain and opportunities in the commercial real estate sector as long as interest rates keep rising. And third, same with the corporate debt sector. Over the last number of years, we've seen the amount of corporate debt out there balloon because corporations went out and borrowed insane amounts of money. And what did they use this money for? Well, some of these corporations use their money to invest into the company, invest in more stores, invest in more research, invest in their products. Some corporations use this money to do something called levered corporate buybacks, meaning you can go out, borrow tons of money and use this money not to go out and buy an income-producing asset, but rather use this money to inflate your stock price. It's good in the short term because it makes the shareholders richer, because if you own a stock and a company does a stock buyback, the stock price goes up. But it can hurt in the long term because that means the corporation has to spend their future earnings to pay back this debt. And it wasn't a big deal when interest rates were at their lowest levels ever in 2020 and 2021. But as interest rates start to go up and the cost of servicing this debt goes up, because again, corporations don't have 30-year fixed rate mortgages, the interest rates readjust. That means that your payments on these debts go up. And we saw a big example of this with Bed Bath & Beyond. Bed Bath & Beyond filed for bankruptcy recently. Why did they have to file for bankruptcy? Well, Bed Bath & Beyond was obviously having struggles with the internet. They were not selling enough on the internet. People weren't buying the Bed Bath & Beyond stuff. But if you look at the financial side of Bed Bath & Beyond, well, they also had their own struggles financially, because in 2021, they had originally issued a $325 million stock buyback. But then the shareholders and the board got together and said, you know what, that's not enough of a stock buyback. We want to see an even bigger rise in our stock price right now. So then they extended the amount of the stock buyback to $625 million. They didn't have all this cash. They had to go into debt. When Bed Bath & Beyond had a lot of debt that they took on. And now they took out the $625 million. And then instead of using that to invest in their e-commerce store, instead of using that money to invest in their employees, to invest in their marketing, they used that $625 million to buy back their own stock, which made their stock price benefit in the short term, help the shareholders in the short term. But now they didn't have the money to continue making their operations. They were bleeding cash, and they had their obligations to pay back their debts. And now, because they had spent that $625 million on stock buybacks, they didn't have money left over to invest back into the company, and they had to declare bankruptcy. So stock buybacks have their own place, but they can be very expensive if you don't manage your money correctly. And this is where now understanding the financials of what's going on is so important, and where interest rates become so important, because the Federal Reserve Bank is going to be working to bring down inflation. And the question is now, are they done raising interest rates, or will they continue to raise interest rates? And we have a lot of different opinions on this. Elon Musk has been calling for the Federal Reserve Bank to start cutting interest rates in 2022, back when the Federal Reserve Bank first started raising interest rates. And the reason why Elon Musk has been so vocal about the Federal Reserve Bank cutting interest rates is partially because he's running a lot of startup companies, things like Tesla, things like SpaceX. All these companies rely on cheap debt. That way they can continue growing, they can continue funding their operations. And so for someone like Elon Musk, when you have these higher interest rates, well, it makes doing business for him much more expensive, because when you're a startup company, when you're trying to grow, and when you're relying on debt, and your debt costs are growing, that means you have to spend more money now to service the debt instead of trying to actually grow the company. So that's where Elon Musk is coming in and saying that the Federal Reserve Bank is going to have to start cutting interest rates sooner rather than later. And he's been saying this since 2022, that the Fed needs to immediately start cutting interest rates, because if the Fed doesn't, according to Elon Musk, he says that we're going to see a big recession, because companies are not going to continue being able to make these higher debt payments, and companies are not going to be going out and borrowing more money. So there's two aspects here, because now when you have higher debt costs, when you see interest rates where they are today, you're less likely to go out and borrow money. And that's what we're seeing happening in the business world. The businesses are seeing interest rates where they are, and they're less likely to borrow money, which means less credit, less money entering our economic system. But the second thing is, if you're a business and you already have debt, well, the debt that you have becomes more expensive, because again, businesses, corporations don't have 30-year fixed rate debt. So when that debt that you have readjusts, whether it's every 5 years or every 7 years or every 3 years, when that debt readjusts, the bank is going to change your payments depending on where interest rates are. And interest rates today are significantly higher than where they were 2 years ago. So now when startups and companies who rely on debt can't go out and borrow more money and then see their expenses rise while revenues are staying the same or falling, that makes it much more difficult for these companies to grow, and it makes it much more difficult for these companies to operate. Now, that's one school of thought, which is Elon Musk. Then you have other schools of thought that are saying the Federal Reserve Bank needs to raise interest rates much more aggressively now, Because if you don't get the inflation problem under control, that's going to create a currency crisis that could risk hyperinflation, that could risk de-dollarization, which are much bigger problems than a recession. And this is where now every person has their own agenda, every person has their own opinions, and every person has their own reasoning for why they believe what they believe. But this is where what I want you to understand is that, yes, we have concerns in our economy. The high inflation is its own concern. High inflation hurts the average person. High inflation is slowing down the economy because when you have high inflation, more money is going to pay down your rent, so you don't have money to go out and buy other things. So high inflation hurts the economy, and high inflation also hurts the dollar, which can cause a lot of issues. A currency crisis is much worse than a recession. Then we have the higher interest rates. Higher interest rates slow down the economy because when somebody goes to buy a home, and let's just say mortgages were 10%, they're much less likely to go out and buy a home at a 10% mortgage than, say, a 3% mortgage. So people are less likely to go out and borrow money, so less dollars entering the economic system, less demand for things, less businesses borrowing money and investing because the cost of the debt is higher. Plus, when you have higher interest rates, the cost of servicing debt also goes up because when you're a business, when you are a commercial landlord, and your debts have to readjust every 5 years, well, in the next 24 months, if interest rates stay high and commercial landlords and corporations have to readjust their debt at 4% higher than what they were paying before, that means you're going to see billions of dollars worth of debt readjust at significantly higher interest rates, where if you're not making enough money, if you're a landlord and you're sitting on vacant properties, or if you're a business with revenues that are not growing and now your debt costs are skyrocketing, you're going to have to make changes. You're going to have to make cuts. What are those cuts? It could be layoffs, it could be laying off divisions, and it could be more bankruptcies because you don't have the ability to continue making all these payments. Then if we take a look at the banking sector, what we see is pretty interesting. Moody's, the credit rating agency, recently downgraded 11 different banks. And what they said, let me read you according to the Wall Street Journal, because Moody's said that there are strains in the way that banks are managing their assets and liabilities, and these strains are becoming, quote, increasingly evident and are pressuring profitability. Recent events have called into question whether some banks' assumed high stability of deposits and their operational nature should be reevaluated. What does that mean? Well, Moody's is saying that they're looking at a lot of these smaller regional banks. And the first thing that happened was when Silicon Valley Bank collapsed, a lot of people went to their small regional banks and they took their money out of the regional banks and they took it to the bigger banks. Why did they do that? Because, well, the way that the Treasury Secretary put it was essentially, if a bank fails, and a bank failure would cause contagion or mass problems to the economy, then the government would come in and they would defend and protect your deposits, which translated to regular people, if you put your money in a big bank and they fail, you're going to be safe. The government will protect you. But if your money is in a small bank and the bank fails, they're not going to protect you beyond the FDIC limits. So a lot of people then moved their money out of the smaller banks and moved it to bigger banks. The government then come in and said, no, that's not what we meant. We are going to protect all banks probably, but we just have to see what happens. So it was a lot of confusion with what they were trying to say and what's actually happening. And then because people moved their money out of smaller banks had a tougher time lending because our banking system is not designed for people to pull their money out of banks. That was where then the Federal Reserve Bank came out and they enacted new lending programs for banks. That way, if you need short-term capital, you could borrow money directly from the Federal Reserve Bank. That way you could stay in business. That was a big help to a lot of these regional banks because now they could borrow billions of dollars from the Fed and stay afloat and continue lending money and continue to stay operational. So then things started to stabilize and we saw a lot of banks come out and say essentially that their deposits have stabilized. But then in the most recent earnings reports that we got from banks, we saw how much money people pulled out of these regional banks, which then created a new wave of concerns. And that was when essentially Moody's came out and said that because of the struggles that these banks are facing, it could pose more long-term issues for the actual bank itself, which is when they then downgraded 11 different banks. And that naturally hurt the stock price of banks. You can start to see where it becomes a self-fulfilling prophecy, where when Moody's downgraded the banks, investors don't want to hold on to a company that is a risky investment. So then people started to sell off of their investments, and that hurt the prices, the stock price of these banks. And when the stock price of a bank goes down, well, that also hurts the bank's ability to go out and raise more money because the valuation of a bank goes down. Think of it like you own a home and you paid $500,000 for it. When the home goes up in value to $1 million, it's easier for you to go out and get a home equity line of credit or to refinance and get cash out. But if the home value drops to $200,000, you're going to have a much more difficult time raising more money. So this is where we're seeing more concerns in the banking sector. We have people saying that we will see more bank failures, but the government, the Federal Reserve Bank, and the FDIC have already essentially opened the door to protecting depositors. We don't know to what extent they will continue protecting depositors. And so this is where there's a lot of confusion. Now, if you ask most wealthy people like Warren Buffett, he has made it very clear that he does not believe nobody will lose money in a bank. So if you put your money in a bank and the bank fails, the government will come in and protect you, which you can pretty much see that the government has set a precedent with that. That if you keep your money in a bank, the government will go out and protect you if the bank fails. That does not mean that banks will be protected from failing. We could see more bank failures. We probably will see more bank failures if interest rates continue to rise, because higher interest rates mean that valuations of things will go down. And if banks are underwater on their assets, and if banks struggle to get more money, and if banks are struggling with profitability, we could see more bank closures. So we're seeing a lot of concerns in the banking market. And the last thing that I want to mention is what's going on in the commercial real estate market. Let me read you this title from Fortune magazine. It says, Morgan Stanley analysts think commercial real estate is heading for something worse than the great financial crisis. Here's what Goldman Sachs and UBS have to say. The reason why Morgan Stanley analysts are concerned about the commercial real estate market is because of two reasons. Number one is over the next 24 months, we're going to see a big chunk, about half of all commercial real estate debt readjusts, because again, commercial real estate debt is not a 30-year fixed rate mortgage. It readjusts every some years. So in the next 24 months, we're going to see about half of the commercial real estate debt readjust at the higher interest rates, assuming the Fed keeps interest rates high. And the second part to that is that we have a lot of office vacancies that are sitting there losing money for landlords. Let me show you a second article. This article right here is from Business Insider, and what it says is that number one, Blackstone reported big losses in the last quarter. Blackstone is one of the largest owners of commercial real estate in the world, and they saw a huge decline in the earnings for commercial real estate properties. According to their numbers, profits from the sale of the assets fell to $4.4 billion over the last quarter, which is down 54% during the first quarter of last year. So while Blackstone didn't actually lose money, their profits are down about 50% from last year, which really isn't that surprising, but it shows you how much slower the real estate market is now compared to a year ago. But it gets even more interesting. Take a look at this. We have another company, Brookfield Corporation, which defaulted recently on $161 million worth of commercial real estate debt tied to office properties. And recently in February, Brookfield also defaulted on $784 million of commercial real estate that was backed by two big office towers in Los Angeles. So what are we seeing happen? We're starting to see some investors, landlords who owned commercial buildings, primarily office buildings, that are now sitting vacant, that are losing money, where then the debt on these properties are being readjusted. And now the landlords are saying, well, if we cannot make the debt payments and then the debt payments readjust at a higher price, we can't continue to make these payments. So either they default, they try to sell it. If you can't sell it, you have to offer a discounted price, or you get stuck in a very deep position where now you have to keep making payments and bleeding cash, literally losing money, because if you own an office building and it's sitting vacant and the tenants are not renewing their leases, you still have expenses to pay. You got to pay your property taxes, you got to pay insurance, you got to pay the maintenance fees, you got to pay the management fees, and then on top of that, you also have to pay your debt payments. Well, if you have no income coming in, you got to pay these payments through your pocket, through your savings, through your other investments. And sure, maybe you can go by for a little while, but then if you have commercial debt that readjusts, like we're seeing happen over the next 24 months, where a big chunk of the commercial real estate debt is going to readjust, and then your monthly payments double because your mortgage payment went from 4% to 8%. Well, now all of a sudden, you're going to see much bigger expenses, which means you're going to need more rental income. But the problem is, if you're sitting there vacant with an office building, with tenants that are not willing to re-sign at a higher price, with tenants that you cannot even find, you're going to struggle making those payments. And this is the tough situation that we're seeing for a lot of commercial real estate across the country, is that this hybrid work from home environment is changing the landscape for commercial real estate. And so now if interest rates stay high, that's going to put a lot of pressure on these office landlords to either A, get tenants back into their offices, B, convert these office buildings to something else like residential, C, try to get more money out of their properties, or D, sell while they still can. This is why you're seeing a lot of experts, some people saying that they are predicting a big shift in the office real estate market, the commercial real estate market, because of all these office landlords who are going to be sitting underwater on their properties with loans coming due, which could cause a lot of loan defaults in the commercial real estate space. This is where, if we go back to the Fortune magazine article, we also have comments from Goldman Sachs and UBS, again, two of the largest investment banks in the world, that also commented on the commercial real estate market. Let me first start by talking about Goldman Sachs, because Goldman Sachs is more along the same lines as Morgan Stanley, where they see pain ahead in the commercial real estate market. Here's what Goldman Sachs had to say. Goldman Sachs says most of the fundamental troubles for commercial real estate preceded last year's backup in policy rates. In other words, the higher interest rates are the reasons why we're going to see a shakeup or more pain in the commercial real estate market, not just because of office vacancies. They said commercial real estate borrowers are already exposed to higher interest rates, which translates to higher funding costs and increased exposure to floating or variable rate liabilities. In other words, commercial real estate by itself is already exposed to higher interest rates, and they have the variable interest rate loans like I talked about earlier. And because they have these higher interest rates plus the variable interest rate loans, we're going to see a big shakeup in the commercial real estate market, particularly the office real estate market, as these interest rates readjust. Goldman Sachs goes on to say that they estimate that $1.07 trillion worth of mortgage loans will mature before the year end 2024, and borrowers' ability and willingness to do so amid higher rates will be limited. In other words, we're going to see over $1 trillion worth of commercial loans readjust, not within the next 24 months, but by the end of 2024. And when those trillion and some loans have to readjust, you're going to see limited interest in the landlords wanting to readjust, meaning more landlords will want to sell. And if more landlords are selling, well, that's more supply of these commercial buildings on the market, which could push the prices of this commercial real estate down. And the third factor that Goldman Sachs highlighted is tightening lending standards. Goldman Sachs points to tighter lending standards ahead and the effect of that on both banks and those within the commercial real estate market. In other words, Goldman Sachs says, for one, that you have these variable interest rate loans and the higher interest rates in commercial real estate. Second, you're going to have less demand for people wanting to actually refinance their real estate. And third, the icing on the cake, the tightening of lending standards is going to make it more difficult for commercial real estate landlords to be able to readjust. And all three of these factors together will cause pain in the commercial real estate market in the coming years. Now let's compare that to UBS. Let's start with the punchline for UBS, because UBS says that, quote, a repeat of the 2008 liquidity crisis is unlikely even if credit tightens further. Now that doesn't mean that UBS believes that we're not going to see a shakeup in the commercial real estate market or that the fundamentals of commercial real estate is different. UBS still believes that we have a large amount of commercial real estate debt that is going to readjust in the near future. What they said is that UBS expects around $1.2 trillion of the outstanding $5.4 trillion commercial real estate debt, aside from multifamily, will mature and be up for refinancing. And that will likely happen amid higher interest rates, which they say will only add to existing challenges around servicing debt, especially in areas like office real estate. So UBS, the bank, essentially agrees with Goldman Sachs and Morgan Stanley as to the risks that are out there and the concerns with the commercial real estate market, but the difference is what UBS thinks will actually play out because of these risks. Take a look. UBS says that those defaults don't necessarily mean that there is risk to the entire commercial real estate sector as a whole. And instead, what they say is that office properties account for only 15% of the commercial real estate market. So UBS, just like every other bank, says, yeah, there are red flags in the commercial real estate market. We have a lot of debt that's going to readjust. This is going to readjust at higher interest rates. But the main sector that is exposed and that will probably hurt is office real estate. Every bank is agreeing on that. But then what UBS says is that because office real estate makes up only 15% of the entire real estate market, that it's not going to create like a domino effect in the real estate market. So what every bank agrees upon is that we're going to see a shakeup, particularly in the office real estate market. But the disagreement is how this office real estate shakeup is going to affect the other sectors of the real estate industry. But it all comes back down to what I was talking about earlier with interest rates and what the Federal Reserve Bank is going to do. This is why you want to keep your eye on what the Federal Reserve Bank does, because if the Federal Reserve Bank continues to raise interest rates and they continue to keep interest rates high, that is going to play a major impact on commercial real estate. It's going to play a major impact on corporate debt. It's going to play a major impact on credit card debt. And it's going to play a major impact in our national debt, because all of these debts are variable interest rates. And if our debts continue to rise or stay high, that's going to make the cost of servicing these debts higher. And while we don't see the exact cost of this yet, as more and more of these debts readjust over the next 12 to 24 months, we're going to slowly start to see the impacts of this, which is why you want to make sure you're staying financially educated. You want to make sure you're prepared and stay on top of what's happening. And of course, we try to keep you updated with Market Briefs, my free financial newsletter, which is why if you haven't joined Market Briefs yet, I highly recommend you do so. And I got the link for you down in the description below. Our last inflation report came in cooler than expected, which naturally has some people excited, claiming the win on the inflation fight, which then poses the next natural question. If inflation is falling, does that still mean that we're going to see a recession? And what's interesting is just a few days after the inflation report came out,